first of all, NSSF. What is this? What are these tier 2, or what is this tier 2 deduction? Where did it start? What does it mean to employees, employers? How do these deductions impact an employer's payroll processing? How can you also be able to make sure as an employer you're not missing out on deducting them? What are some of the systems, in this case, for example, Workpay, that can enable you to automate that? The second bit that we'll understand from a flow perspective is, what does it mean to opt out of this NSSF tier 2? What is the process? What are the benefits? What are some of the compliance and legal consideration for employers? And then addressing any other concerns in regards to this NSSF tier 2. Probably it's a very new thing to almost all of us, because I know the different people joining this conversation are both employees and employers. As an employee, you want to know, where's your money going? As an employer, you want to know, how do I make sure that I am 100% compliant while exploring all the options that I can have to make sure that my employees are happy? All right, moving on. Happy to introduce the key team members who will be taking us through today's session in terms of just being able to facilitate us from an understanding perspective. I'll start off with Joshua. So Joshua is a global payroll manager here at Workpay, in charge of payroll ops. These are the people you run to and you're saying, I think there's something that has changed. What does this mean? So Joshua is an expert in payroll management. He'll be able to break down to us how these deductions work, what is the impact of payroll processing, and what employers need to consider to stay compliant while optimizing their contributions. So he will take care of the first session that will be around understanding NSSF tier 2 deductions. Our second speaker of the day is Christine Karoke. I'll be able to also introduce her before she comes on with all the good things about her. But for you to understand, she has a very deep expertise in pensions and retirement planning, and she'll help us break down this NSSF tier 2 opt-out process and provide clarity on why private pension funds might be a game changer for employers and employees like her. She works at Old Mutual Insurance as the head of pensions, so you can already feel at home and you're sure that you have the right person in this conversation. All right, we're good to go. We're going to start with a quick poll. Just are you done running the poll? We're going to start with a quick poll that is going to pop up on your screen, whereby you just quickly tell us, have you noticed a change in your take-home pay this month? That is the month of February. Just please proceed to share the poll. Please participate in as much as possible on the polls that we'll be sharing out for us to keep this session engaging. Remember to keep sending your questions, your comments on the chat, so that we all live here 100% informed. I'm really excited to see some of our Workpay clients on our chat board, on the attendee. I like that. Just, it is not up yet.
Yes.
All right. Okay.
About time to deductions. Everybody's talking about reduced.
All right. If you want to participate in the poll, please click on the poll tab or the poll icon. It's more of, three bars, and then you'll be able to just quickly look into the first question.
So you can just go through the questions and things.
I can see that you guys are voting in. Very many people are saying, they've seen a lot of reduced take-home pay. Let's keep voting. I can only see 54 out of 106 participants have voted. Let's keep putting in. 51% of us are saying they have seen a reduction. I like that most of our employers are compliant. We'd be worried if a lot of people were saying they have not seen any changes. Let's keep voting for the next 1 minute. Thank you to everyone who's voting. I can see very good feedback there. We have 65% people putting in their votes. Let's keep going. All right. So what is 100% clear is that all of us have seen a huge reduction in our take home. That would be probably your subscription to the Netflix for that particular month. So I'm really excited to see how, despite our take home getting lower, are we able to redirect this money to something that is a long-term payment or a long-term benefit for all of us, and how that pans out. Christine, we're really excited about your session. But before that, we're going to go right into now getting to understand what is this NSSF Tier 2. Everyone keeps talking about Tier 1, Tier 2. As an employee, as an employer, you don't really understand where you fall. How do you need to calculate that? And I'm going to send this quickly to Josh. Josh, can I proceed and share my screen on your behalf, or you're more than happy to share it on your end?
Well, just share on my behalf.
Sorry?
Yeah, you can share on my behalf.
Okay. Well, at least let's keep voting on what our feedback is on our take home. I'm worried about the percentage of people who have not voted. I'm waiting for people to say no. I did not see any reduction on my salary, so that we are able to align and find out who's currently not compliant in their organization. All right, I'm quickly sharing my screen. So the first session that we're getting into right now is just understanding NSSF Tier 2. What does it mean? Of course, Josh is going to break it down for us. What is Tier 1? What is Tier 2? What are the changes that have happened, at least in the last not 3 years, but the last 3 changes, because these changes keep changing, even not on an annual basis, but on a very different periodic time. I'm quickly sharing my screen. Okay, please confirm that you can see my screen. Perfect. Josh, over to you. Josh, if you're speaking, we can't hear you.
I think I lost you there for a minute. Hear me?
Okay. You're back now. Perfect. You can proceed.
Well, good afternoon.
Josh, I think there's a technical issue on your side. Would you please check in, because we can't hear you? Okay, we are almost there. We are almost getting you back. All right. While we're waiting for Josh to just quickly resolve his connection issue, I think we're looking great on the polls. Everyone is
Sorry, guys, I had a slight internet issue. I hope now you can hear me.
perfectly great. Can you hear us on your side?
Can you hear me?
I can hear you perfectly. Can you hear me?
Okay, I can't hear you guys. So Just give me a thumbs up if you can hear me. Okay, cool. So the new NSSF tier-based. Thanks, guys, for the thumbs up. Just to give you a brief history of where we are coming from with this NSSF tier-based. Previously, as you are aware, NSSF was just a flat rate of 200. Then in 2013, there was a new act. It's called the NSSF Act of 2013, which was proposed, but due to the back and forth of courts and all that, it never materialized in 2013. But in 2023, it was finally put in place, became effective, and the government proposed the act proposes a tier-based system. So with the tier-based system, if you can just go to the next page, please. So the tier-based system was meant to be progressive and implemented in 5 years. So starting from 2023. Okay. So the proposal was to have something called the lower earning limit and the upper earning limit, which brought about an issue, something called tier 1 and tier 2. So tier 1 is actually limited by the lower earning limit, while tier 2 is controlled by the upper earning limit. I'll explain later what those two are, so don't worry. So for the tier 1, it takes your salary from 0 to the lower earning limit, which in 2023, as you can see from the screen, was 6,000. So it will take your earning from 0 to 6,000. If your salary is up to 6,000, it will do 6% of that, and it will get tier 1, your tier 1 deduction as 360. Then in 2024, that increased to 7,000. So 6% of 7,000, your contribution towards tier 1 was 420. Then currently in 2025, that was increased to 8,000. So 6% of 8,480, that was your contributions toward tier 1 as an employee. That was what was deducted from your base. But the employer is mandated to also match your contribution. So as you can see, the total tier 1 contribution that will go to NSSF is as of 2025 is 960. So that is the current approach for the tier 1 rates. Please note that next year it will increase. So the lower earning limit that will be used to compute tier 1 will be 8,000. Then in 2026 it will be 9,000, and for 2027 it will be communicated. Okay, if you can go to next page. So for the tier 2, it's also based on your salary, but this time, since the first 6,000, 7,000, and 8,000 of your salary has already been used to compute tier 1, so for tier 2, it will always take the difference between the lower earning limit and what the NSSF Act proposes as the upper earning limit. So the upper earning limit, just to give you a brief history of what it is, upper earning limit is dictated by what we call the national average earning. So this is something that the Kenya National Bureau of Statistics does the statistics and says the national average earning this year will be 36,000. So that is what was proposed back in 2023, and it has remained constant for 2 years until up to 2025. So as per the Act, the upper earning limit for the first year, which was 2023, was to be 50% of the national average earning, which was 36,000. So 50% of it, the upper earning limit became 18,000, as you can see from the screen. So how do you arrive at tier 2? You take the difference now between the upper earning limit of 18,000 and the lower earning limit of 6,000 in 2023. In 2024, that was the upper earning limit was now 1 time the national average. So it was 36,000. So to arrive at tier 2, you take 36,000 minus the lower earning limit, which remember was also increased in 2024. So it becomes 36,000 minus 7,000 times 6%, and you will get 1740. That is what will be deducted from, it was deducted last year from your salary as tier 2. Then in 2025 currently, so the upper earning limit is 2 times, as you can see on the column return rate, it's twice the national average earning of 36,000. So 36,000 times 2, you get 72. That is the upper earning limit. So to arrive at tier 2, you take the 8,000 that was also increased, the 72,000 minus the 8,000, then you do 6% of that, and you will end up with 3840. That is what is deemed your contribution as an employee towards tier 2. And the employer is supposed to match that. So it becomes 7680. I hope we are clear up to that point. Okay. So just to give you a brief image of what these changes cost into a payslip. So as you can see on the left is a payslip for a person earning 100,000 in January, because these changes happen every February. So then the new rates took effect as of February 2025. Okay. So as of January, we are still using the year 2 rates. So as you can see on the payslip on the left, the NSSF for this employee was 2160. Okay. And the NSSF for February rose to 4320. So these 2160 and 4220 is a sum of both tier 1 and tier 2. Remember, with the act, it's mandatory for you to contribute both tier 1, to be deducted both tier 1 and tier 2. So just because there is tier 1 and tier 2 doesn't mean you can say I will just contribute tier 1. No, you'll have to contribute 6% of your pensionable earnings up to the set limit, which for the year 25-25 it's 72,000. So as you can see, the NSSF, if in this third payslip, this is assuming the new NSSF Act of 2023 was not implemented. That means your NSSF would have remained at 200. So if you can just go back to the previous, I want you to take note of 2 things: your net pay, the change in net pay, and the change in pay. So as you can see on the left, the pay is slightly high. It's 20,000 and NSSF is 2160. If you go to the next, if you go to the payslip on the right, you'll see the pay has reduced, but NSSF contribution has increased. No, you're wondering what has changed. So there's something we call deductibles, so, or contribution benefit. So any amount you contribute towards your pension, you are allowed to reduce that from your gross to arrive at the taxable pay. So that means if you're earning 100, you reduce you reduce that gross by 2160, and then with SHIF and affordable housing levy. So the more you contribute towards your pension, the lesser your tax will be. So just to give you a brief understanding of why this is important, pay is a tax. You'll never get it back. NSSF is a saving towards your pension. So when you retire, you're going to get your money back plus interest that you will have accrued throughout the years. So if you can manage to save more towards your pension, the government encourages that by ensuring that your burden of tax is reduced. And considering that there are 2 ways to look at it, you can complain here. My net salary has reduced, as you can see from the 2 payslip. But remember, the employer is matching that. So it's a win-win for you. Okay? Because if you would have been given that extra 2160, chances are it will have remained as 2160. But remember, the company is also contributing towards your pension. That means you have a 100% earning. And I don't think there's any business here in Kenya you can open, and every month you're getting 100% return on investment. So you can choose to look at it either as glass half empty or half full. Okay. So, any question up to that?
All right. Thank you, Josh. You've done an amazing job. And just thinking about it from my understanding, being a math person and just going back to this presentation, so what you're currently saying is that everyone right now is subjected to both tier 1 and tier 2, not unless you opt out, which Christine is going to take care of. So the first things that you said is that NSSF is a pension contribution deducted from your salary, and it's usually deducted from your gross pay. So that's one. So it automatically deducts, or rather reduces, your taxable amount. I think that's my first takeaway from this conversation, based on us understanding what is this NSSF thing. And then now going back to the tier 1 rates, is that for tier 1 or tier 1, depends on which school you went to. For tier 1 is the maximum at this point is 8,000. So we're talking about a 6% subjected to the maximum limit, which is 8,000. And at this particular point, when you say 8,000 divided, or rather multiplied by 6%, is 480. So that is the first tier 1 amount. And then for us to compute everything 100%, to be able to calculate the total NSSF, we go back to now the tier 2 and say we are also calculating 6% of the difference. All right. So 72,000 we divide by 8,000. So we deduct 8,000. So we get a balance of 64,000. And this is what we're saying, 6% of 64,000, that becomes 3840. Is that what you're saying, Josh? Josh, if you had me, we lost Josh. All right. I think that is what Josh meant from a perspective of how this is calculated, so that you're able to figure out what is this 3840. It's coming from 6% of the difference between the upper limit of of the tier 2, the upper limit of tier 2 deducted by the upper limit of tier 1, you get 64,000. Then you multiply that by 6%, it gives you 3840. And then remember, to be able to calculate the total NSSF that you should deduct from your employee, is you add with the tier 1 deduction, which is the 480, giving you the current 4320. So the total amount that you should deduct from this particular employee, or rather, employee and what the employer is contributing, is the 4320 added on to, the 4320 that is being contributed by the employer. All right. I think that's a proper understanding right there. If we are all together, I don't see any questions on the chat. Just, are you seeing anything from people in regards to understanding this NSSF tier 2 deduction? Are we seeing any questions?
No, I haven't got yet.
All right. So, Josh, welcome back. Apologies for the challenges you have experienced. So to clarify, I can see some questions in there. Probably we would have started by speaking about this entire policy applies to the Kenyan market. So I can see a quick question there about Nigeria. So this is only applicable to the Kenya employees. There's a quick question up there. Hi, for the sake of filing NSSF deductions, will Workpay give an option to extract tier 1 and tier 2 combined or separately? Should we choose to move to tier 2 deductions to another vendor? That is where Christine is going to come in, and we're going to respond to those questions. Is the change impacting employees in from Kenya only or everywhere. I think we have responded to that this is only a Kenyan NSSF policy. Okay, we got a few bits there. Is NSSF deducted from gross pay or basic pay? Josh?
Okay, that's a very good question. So the NSSF Act is very specific. It states that your NSSF will be computed on your pensionable earning. So by pensionable earning, what that means is that your basic wages plus fixed allowances and benefits in kind. So if you have things that are recurrent other than your basic, they should be used to compute your NSSF.
All right. Thank you, Josh. Probably we can quickly go to Christine and then we'll be able to answer all these questions together. I see Christine has been responding to some of the questions on the chat. So I'm going to do another reintroduction of our insurance guru who's going to tell us where do we take this pension, how do we make it work for us? Thank you so much, Josh, for that very good input right there. Probably you can also go into the chat bot and find those key questions that we are getting from the different people so that we're able to just make sure everybody goes home happy. So just going into Christine. Christine, welcome to this side. We're really excited to hear from you. So Christine, of course, I mentioned, is the head of pensions at Old Mutual. She has slightly above 22 years in the employee benefits sector. And I know right now, once you get into employment, all you think about is, how am I going to retire? And Christine is here telling us, okay, you can stay in employment, but these are some of the benefits and these are some of the ways you can just change the whole overview of your retirement benefit scheme. Thank you very much, Christine. I am passing over the mic to you and you'll also be able to share your screen. Happy to hear from you. Karibu sana.
Thank you, Joylene. Please confirm if you can hear me and you can see my window, the slide. Okay, perfect. Thank you very much. I'll briefly add on to what Joshua has said, and for me will be more to elucidate in terms of how it practically comes together. So the first thing I want to say is the National Social Security Fund is a jurisdictional clause in Kenya and practicable in Kenya, though it does have arrangements for concessions to the East African countries. Additionally, I want to state that it is a statutory deduction. And so statutory deductions are the responsibility of the employer. But we do also know that employees have the benefits that align with NSSF, which I'll speak into, also align with what the employer is seeking and what would benefit the employee. Now, for purposes of our conversation, before I speak about opting out, because that was the specific space I want to speak into, I want to draw a narrative so that we know where we land. So when you look at a retirement benefits in Kenya, you're basically saying that throughout your working lifetime, you continue to put out money. And when you put out this money, at the end, the responsibility that this money has grown to be able to replace your income. So that's just the basic narrative. So whether you're talking about a private retirement fund or whether you're talking about NSSF, the goal is to accumulate a fund that you can convert to replace your salary. So we're in the first phase of this. And in pre-retirement, or what we call the saving phase, you can put your money into 3 avenues or schemes in Kenya. You can put them in what we call an employer-based fund, which is what we call an occupational scheme. You can put them into an umbrella scheme, and you can put them into an individual scheme. For the function of NSSF, we're very clear that the employer-based fund or the occupational or the umbrella are where the savings go. However, individual funds are available for people who change employment and do not want to put that money back into NSSF. They can cash them or basically park them until they are available in an individual scheme. So the rule is that this retirement fund should be able to receive NSSF. I'd also like to highlight, before I get into opting out or what we call contracting out, two different kinds of retirement funds. So globally, retirement funds can either be provident or can be pension scheme. So when you have a provident fund, at retirement, meaning at the age of retirement that is prescribed for that retirement fund, you can opt what to do with your benefits. So provident funds allow you 100% encashment, or you can convert to a post-retirement income. And the post-retirement income can be either an annuity, an income drawdown, or whichever you want. But that is outside the scope of this conversation today. If you're a member of a pension scheme, the rules stipulate that you can only access 1/3 in cash. 2/3 you have to convert into a post-retirement income, which I had described as either an annuity or an income. So for purposes of our conversation, we need to note that NSSF, the old fund, which was the 200 shillings we were putting, was a provident fund. So that has been closed up. And we are now all members of the new fund, which is a pension scheme. So that means that the funds we are saving in this new dispensation, at the point where they're ready for access, which is at retirement, you can only access 1/3 in cash, and 2/3 you have to convert into a post-retirement income. So one of the things people are asking is, why has it increased? One of the things that you need to understand about why NSSF has increased is because there's very little, in my years, I've seen people going home and they've not thought about, when my salary stops, what next? Your bills do not retire, but your salary does retire. So what's the plan? And I think the spirit of the law was to increase what we call coverage, because currently as we sit, Kenya has an average workforce of 14 million. Around only 1/5 of that have any adequate savings, and that is in private schemes. So National Social Security Fund, being statutory, was meant to increase this coverage from less than 20% to around 60% of the workforce. So for us to understand what Joshua had shared earlier, Kenya has a 3-pillar system. So in a 3-pillar system, when you look, the first pillar is statutory deductions. And this, for us, for our conversation, is the National Social Security Fund. The second pillar...
Sorry,
yes.
Your slides are not moving.
Have you?
On your slides.
Can you see?
I can see your screen, or we can see your screen, but your slides are not moving.
Sorry about that.
Or maybe you're on a different screen. Can try that.
No, kindly allow me to reshare again.
Okay, perfect.
Members need to see this very quickly so that we save time. Share screen. Allow me to share my tab in the window was not sharing. Kindly confirm when you can see this a different slide. Can you see my slides moving?
Yes. Okay.
Oh,
try
perfect.
moving.
Now you can see.
Moving.
Okay. Thank you for letting me know. So when we talk about Kenya, the 3-pillar system, globally, usually you're either 2-pillar, 3-pillar. So Kenya is 3-pillar. So mandatory is National Social Security Fund. Then what happens is that beyond that, employers will set up what we call private institutional schemes. And these contracts are based on a benefit that is given to you by your employer, just like you would have medical benefit. So under this, you have 2 kinds of retirement funds: a standalone fund, where the employer registers this fund and runs it from his end, and then employs service providers like Old Mutual to be able to do the investment for them. A more recent construct is what we call an umbrella retirement scheme. So this one came into force in 2015. And you find that in a retirement scheme, in an umbrella scheme, it's just that it's an umbrella that covers diverse employers. So employers are saying, I don't want, my main core competence is not running a retirement fund. It takes a bit of expertise, a bit of effort, and it costs me money. So I will join an already existing scheme. And in this scheme, I'm not responsible for anything. It's a plug and play solution. I just join. So you find that because contracting out, when I describe it, is the responsibility of the employer, you land in an employer-based plan. So you either will be an occupational scheme or an umbrella scheme, but the fit that fits most employers out there, because they already did not have retirement schemes, is the umbrella scheme. We do recognize that majority is individuals. So when an individual does not have a retirement benefits in the employer, or they work for successive employers and want to consolidate their benefits under their own personal view, then they use what we call the individual plan, which is the 3rd pillar in retirement. So I'll not repeat what Joshua had exclaimed, but I want to say this is not new. The Act was passed in 2013 and came into force in 2023, specifically the 3rd of February. So we've been doing a progression. I want to highlight the benefits. The benefits is a retirement pension, meaning you get it at age 60, or Kenya recognizes an early retirement age of 50. And at that point, you access 1/3, 2/3 you get paid, you or convert into an income. You can get an immigration benefit if the deductions were done and you're not a Kenyan resident. If you're not an East African resident, then these benefits will be paid to you. If you retire on grounds of ill health before you reach your retirement age, the fund will allow you to take a pension out of it. In the event of untimely demise, your accumulated fund is paid to your nominated beneficiaries as a survivor's benefit. And if you've done contributions for more than 36 months, you get a funeral grant. So Joshua has already explained that the contributions we are contributing is from the employee. You look at it as 6% and the employer 6%. And this contribution, when remitted, is broken into two parts, a tier 1 and tier 2. And it's based on the salary schedule that Joshua had shared. So this will be shared.
Your slides are still not moving.
What? It stopped moving again.
Yeah. What you can do, try sharing in slide mode or presentation mode and like the entire document. Try that, then you can keep moving.
Hold on. Can you see them again?
We can do a test. Yeah. I think the screen should be coming up shortly. It's not on our screen yet.
I need to share differently. Kindly allow me to share differently.
No worries. Take your time.
Give me 1 minute. Can you see my screen?
It's coming up. Yes. Perfect. Now it's in presentation mode. Try moving to the next screen. Let's see. Great. Okay, now you can go back to the one you were.
Please let me know, because I have one more slide to go before I wind up, and I'd not like people to miss out. So when we look at the contributions, Joshua did illustrate the limits. So what we need to understand is NSSF is 6%. However, there's an upper cap, meaning that there's a salary, you charge 6% to a certain salary limit. So in the current year, the salary limit is 72,000. Next year, it will move to 108,000. And the year after that, it will move to 144,000. So this is a published schedule, and it's based on what Joshua had shared as the national average earnings. If that shifts, then the whole table shifts. Also, what you need to know is if your salary is below this, then you're charged 6% up to your full salary, because you can't be charged for money you don't earn. So what that basically means is that in the year 2025, if you're earning more than 72,000, we will charge you 6%. You'll be charged by your payroll office 6% up to the salary of 72,000. Of this, it gives you 4,320, of which 3,840 is tier 2, 480 is tier 1, and so on and so forth for the successive years. So the question we are having a conversation around today is 3,840 times 2 is 7,280. That's quite a sizable amount of money. So the law allows you, confirm that you can see my screen.
Yes. Move to the next.
Allows
Wait, which screen are you on? Are you still on the NSSF?
The table. Yes.
Great. You can say it perfectly.
Okay. So the law allows that through the employer who does statutory deductions, you can opt out, or rather the word that is used is contract out. So what does contract out mean? Contract out means that you are given permission to contract out of NSSF and contract into a private fund. So you may ask yourself, why that? It's not an exemption for you to do the deduction. The deduction must be done, but you're basically asking for permission to be allowed to invest the tier 2. And if you look at the tier 2 column there, it's quite a sizable amount of money. So when you double it, meaning the employee and employer portion, it's quite a sizable amount of money. So what you're saying is you're asking for permission to be able to invest it outside of the National Social Security Fund. And we'll look at the reasons why you need those, that the considerations for both the employee and the employer. So the first reason is usually basically that the performance of the earnings. So I've done a very simple calculation. We've been asked, so we're assuming a performance rate of 10%. So our fund has been at an average. So when you look at retirement funds, you look at an average of 10 years because it's not short term. In essence, majority of us will be in NSSF between 25 to 30 years or 40 years, depending on how young you are when you start working, because it's a statutory deduction. So we assumed an interest rate of 10%. We assumed the employee contribution of 6%, the employer contribution of 6%. We assumed a modest salary increment every year of 3%. And we assumed a normal retirement age of 60, which is the NSSF age of 60. So when you contract out, you're basically investing your money into a private fund. So using the old mutual staff fund, I took somebody who is earning 72,000. So the 4320 and the 4320, if you look at that calculation, that means that in a month, this person is doing 8,640. If you multiply that by 12 months, this person will have contributed 103,680 to a retirement fund. Now, if you multiply that by 25 years, it means the capital or the principal or the actual money you'll have put into that fund is around 2,492,000. So for the sake of this conversation, we say it's 2.5 million. But if the fund earned 10%, this person would eventually go home with around 14 million. So we're basically saying this is what 10% does. So 10% means that the earnings of the first year will multiply by the second year, by the third year. So compounding, which is the first principle of investment, is very key and important for this. When we convert the 14 million into a salary that you will receive monthly for the rest of your life, which is the intention of the NSSF deductions, it comes to around 158,000 per month. So what we say, because remember I said the whole idea of a retirement fund is for you to save. And when you accumulate the fund, for it to replace your income. So the income replacement factor is 109%, which is very good, meaning that you've replaced your last salary by 109%. Please confirm you can see the next image which has an interest rate of 4%. Thank you. So if you take the same person and with their 2.5 million, having put it in, remember the math remains the same. You're contributing 4320, 4320. At a rate of 4%, which is the last published and gazetted results, you find the person has 6.1 million. So 6.1 million, you're replacing your salary at 47%. So if you are earning 100,000, it means in retirement, you're getting 47% of what you are earning, and you can't squeeze your lifestyle because you're used to 100,000 below that. So the first, what we'd call value for contracting out means that you earn a higher return, 14 million vis-a-vis 6.18 million. So let me speak slightly on contracting out. So contracting out says you do two things. One, you have to be a member of a private retirement scheme. So for us, that means you have to be a member of the umbrella scheme. This is a plug and play solution. The employer fills an application and joins and becomes a member of the umbrella scheme. So that's step one. Step two, in terms of compliance, is then you make an application to the Retirement Benefits Authority, and the application is in a certain format and manner, and we do that application on your behalf. We handhold you through this process and the steps, and there's quite a bit of documentation. But we've made it easy by preparing contracts and templates ready, which have been approved by the regulator. So when you make this application within 30 days, the Retirement Benefits Authority gives you a certificate. So when they give you this certificate, the certificate is issued to the employer. And this certificate says that you, company XYZ, are now approved to remit your statutory Tier 2 contributions to the old mutual umbrella scheme, and you will remit it from effective X date. So that is what contracting out is. You become a member of a private retirement fund and you make an application to be allowed to redirect your Tier 2 to a private retirement fund, and you get a certificate for it. Mandatory tier 1 has to go to NSSF. Tier 2 is what is contracted out, or rather, for purposes of me explaining, invested into a private retirement fund. And we've seen the first reason why. So within a certain period, then you get to put in your money. So if you're looking at it, the second reason is the issue of online platforms. A lot of us, if we look at because I've worked for 22 years, when I try to get my NSSF statement from the old fund, it's really, really a pain in the you-know-where. So I usually say, having an online platform is the other thing that an employer will be able to provide. So the employer will be able to run reports themselves, and the employee will also be able to run reports themselves to be able to track their contributions. So that is a very key important factor. So I'm showing pages of the landing page to show that there are reality, that the employer can be able to run their own reports and the employee can be able to run their own reports. Additionally, you get an immediate statement. So if you want to check your statements, you're able to check your statement as an individual and see your statement. Going into the other reasons is one, the issue of governance, accountability, and transparency. Those are key things to be able to say that you can be able to do. The third is portability. What does portability means? That it's like this NSSF fund moves with you. So if I work for work pay today and they are contracted out, when I move to Old Mutual, I will transfer my NSSF tier 2 to the Old Mutual fund because they're also contracted out, and I will continue to grow. So you move with your fund, and that means it gives you a responsibility to be able to see this fund and be able to manage it and understand it. Self-view, we've talked about it, consolidation, retirement options are available for you. And of course, now, the other thing is you're joining a low-cost scheme. So from the last published results, you will note that NSSF say that their expense margin is 30%. So for every shilling you give, 30% goes into expensing. If we look at the Old Mutual, the declaration in the contract is 1.25%. So the difference between 30% and 1.25 is quite vast in terms of an expense margin. Then, of course, the issue of performance, average performance of 11% vis-a-vis an average performance of 4%. I think I'd like to pause there. And Joylina, back to you, hoping I'm keeping good time to give people time to ask their questions.
All right. Thank you, Christine. That was very informative. Confirm that you can hear me. There is a workflow here. I know you have talked about what does it mean to opt out? What is the process for, to opt out and register with a private pension firm or rather pension scheme? Could you give us insights on that?
Okay. So the first step is usually you join a retirement fund. So we recommend the umbrella fund because it's a plug and play solution. So you make an application. That's the first one. You fill in your details. You remember there is the employer, the scheme has to see your details. And all retirement schemes in Kenya are trust funds. So you make an application to the trustees. So you fill a certain form and you declare your details, attach your PIN and attach your certificate of incorporation or registration certificate, however you're constituted under the laws of Kenya. When we receive that, we give you something called a deed of joining. So a retirement fund being a trust, you join using a deed. So it's a 3-page document and it has 3 very simple constructs. 1, the date you join. 2nd, your contribution rate, which will be the NSSF tier 2. And thirdly, the retirement age of the members. We find that there are some institutions that could have 55 years as their normal retirement age. So that deed will be signed by yourself and the trustees of the scheme. And that is a document that confirms to the Retirement Benefits Authority that you are a member of a retirement fund. The second, which could be driven concurrently, is you make an application to the Retirement Benefits Authority to contract out or opt out of NSSF and into your private scheme, which is the umbrella scheme. So that requires 5 requirements. The first is there's a form prescribed by law, which you complete, and we help you complete that. The second is that the resolution of the board of the organization where they resolve to contract out to show that they did make a resolution. The third is an undertaking by the employer, which means management will undertake to make the statutory deductions and in the right manner and comply with the law. The fourth is a notice to staff. this thing is not done in isolation. Those statutory deductions are mandatory. So the notice to staff is to let them know that we as an employer wish to contract out, and we are contracting out from this period. So you write maybe the 1st of April. And then the final one is you remit to the regulator a list of your staff, their IDs, their PIN numbers, and the NSSF registration. On our end, so when these two things go, your confirmation that you're a member of a scheme through the deed. The second is the application through the documents I've stated. Retirement Benefits Authority responds to you in 30 days and they give you a certificate. We've not had a declinature. When you get the certificate, then from the date on the certificate, you remit your tier 1 to NSSF and you remit your tier 2 to us. On a quarterly basis, we're required to confirm that you're complying with statutory deductions, both to NSSF and the Retirement Benefits Authority, to ensure that you're keeping up with your statutory deduction, because this is statutory. You can't have lapses. Yeah.
All right. Thank you, Christine. I think you have clearly mentioned aspects on, what are the benefits, because that is something else that we wanted to understand. What is the benefit? I know I'm being deducted this amount of money by my employer, but then at an individual level or even at a company level, what are the benefits to my employee when we choose a private pension fund for, to just send over our NSSF tier 2 contributions. So I like that you spoke about the better interest rates. Who's not out there to grow their money from 4% to 11%, and then you get a good payout at the end of the day. Thank you for also sharing out information about the compliance and legal considerations for employers. Now, we have some quick questions on our chat side that Christine would be more than happy to respond. I see Josh has been able to pick a number of them and respond to a couple of people who have responded. But for me to also just start off so that you can get pretty good clarification on the NSSF tier 1 and tier 2, if I am earning more than 72,000, my total contribution is going to be 6% of 72,000, but my first 480 is a contribution to tier 1 that has to go to NSSF, and then the 3480, if I am not wrong, in terms of the contribution, goes to 3840. Yes. So the first 480, if I'm earning anything above 72,000, 6% of that, but the first 6% of 8,000 would go to NSSF, and then the balance is what can be remitted to a private pension scheme. Is that right, Christine?
Yes, that is right. For NSSF, you have a cap, and Joshua had indicated the cap.
Yes.
It's 6% up to a certain limit. So you're very correct in what you've illustrated. And I've displayed the table again, just in case someone wants to refresh.
All right, great. Now let's think about someone who's in between, who's not at 72,000 and beyond. So the first 6,000 of, the first 6% of 8,000 is what goes to NSSF as tier 1. If they opt out, the second 6,000 of the difference between their gross and the first 8,000 is what would go to tier 2, right, Christine?
Yes. So if you take someone who's earning 50,000, their contribution is 3,000, isn't it?
Yeah.
So if you take that person, so if you take the 3,000, then the first 480 is already determined, which is tier 1. Then the remainder, which would be 2,520, would be your tier 2. So that is what would be up for grabs for your employer to be able to contract out for you into a private scheme.
Great. Thank you very much. We have an interesting question here. Someone in the game of numbers, and they're wondering, why is tier 1 increasing with 1,000 every year? I'm wondering why you're not looking at the upper limit of tier 2. It's quite high. It's going up with a 36,000 difference. What is the trend? Is it a math thing, Christine, based on your experience?
In terms of tier 1?
Yeah, if you look at the lower limit.
Yeah. Okay, so moves from 7,000 to 8,000 to 9,000 to 10,000. And then after that, they'll gazette. So the principle of the lower earning limit is based on minimum wage averaging across the counties. and that is the basis on which they arrived at the schedule. So I've taken a bit of, it's not in the Act, but I took a bit of just looking at the background of the Act and how it came about. So it's based on looking at minimum average wage earnings and looking at it. Also, it's also the designated fund for expensing and margining, which is why it has to remain in NSSF for the running of NSSF functions. My hope is that it will also earn an income that will be able to cover for expenses that you actually get it back at retirement.
Why are you scaring us? And we've just started. Okay.
I'm just speaking the plain truth.
I know. What happened to the previous Provident Fund that was there? Because you mentioned something about it being closed up with the current Tier 1 and Tier 2 being rolled out.
So the previous Provident Fund, which was payable to us, which was the 200 plus 200, making 400 per month, it's now called the old fund. The new regulations state that within 5 years of setup of this new fund, they should prepare regulations and guidelines towards how to treat it. So currently, they're just paying people. If you retire, you're paid from the new and the old. But we expect that maybe they will give us instructions. Sorry about that. That they will give us instructions to be able to say either it's put into the new fund. That would be our expectation, but we're waiting for them to prepare guidelines and regulations on how it shall be treated.
All right. Thank you for that very detailed response. I think I will. Just a sec. I'm just muting one of us. All right. The other question is, do personal pension plans attract interest, or how can you ask your fund manager to maximize the benefits of your individual pension plan contributions?
There's no retirement fund that doesn't attract an investment return, because the goal of it is to grow your retirement funds to be able to give you value for your money. So yes, they do attract an investment return, and you can find through your financial advisor or even calling someone at Old Mutual how to compare funds in the market to know whether you're good. And the beauty of an individual fund is that it's very portable. If you're not happy with your current provider, you move to the person you see being able, based on the criteria that you use to assess them.
I agree. I have been able to move my personal pension fund from a previous scheme to another one. So yeah, so what the person who asked that question, what Christine is saying, is that just move over to Old Mutual. They have great rates for you on the personal pension fund. All right. To understand Christine's presentation today, contracting out of Tier 2 can only be done by employer and not by individual to join a private fund, right? Yes. Right. So to also, okay, great. Proceed.
I was agreeing with you.
Okay, perfect. Yeah. So please remember that this is an employer deduction on your salary. It's not a personal deduction that you get to decide whether it's deducted or not, or where it goes. So the contracting out of Tier 2 is done by the employer, but remember the process that Christine spoke about, the resolution of the board, the documentation that they have to prepare, and also, informing the employees that this is where your funds are going to go to. They'll no longer go to NSSF, and on the go, when you move to another organization, then you'd be able to transfer your fund, or rather your money can still be payable to the private provident fund if the other organization still has that particular scheme. All right. I think there's a question here. Christine, you can add it to your slides. Could you please mention the other umbrella pension schemes in addition to Old Mutual? So you can add that to your slides, Christine. So in Company X, employees are eligible for pension after successful completion of probation. That is usually very, very obvious, even the medical insurances, etc. So they're asking, if you contracted out and got an approval, does it mean I will have to separate the Tier 2 deductions? Ones not in the scheme goes to an NSSF, and the ones in the scheme go to the scheme. I hope you understand that question.
So my understanding, and I'll stand to be corrected, is when you have a private scheme, what we are calling tier 3 now, because remember NSSF has taken tier 1 and tier 2. Tier 3 is a private contribution put in your contract. Sometimes the employer will put impositions on you to say you will join when you finish your probation. But NSSF is statutory, so the minute you join, you join.
Yeah.
I also want to add a provision that not everyone in a company based on their contract enjoys tier 3. So you'll find that the permanent and pensionable staff have tier 3. The contract and the casuals have only NSSF. So the way we manage it is we separate the funds. So you as the employer, when you're doing your payroll deduction, everybody, the permanent and pensionable, the contract and the casuals are doing NSSF. So the tier 2 will come to us and will fall into the tier 2 fund. The tier 3 that you have been doing, the ones who qualify, you remit to us as an additional value, and we remit it to the client's fund. When the person then becomes eligible, then you add them and you do your deduction. So in your statement, if I'm a permanent and pensionable staff, I will see my normal tier 3 contributions, if I'm qualified after probation, and my NSSF tier 2. If I'm a casual staff or on contract, I will only see tier 2. I think that's how I will explain it for that question.
I feel like I am in a class already, understanding the tier 1, 2, and 3. So to reiterate, Christine has said the private pension fund for the organization that you're added post-probation is the tier 3. So that means that is the organization one, but this is a statutory deduction. So depending on how your organization is currently treating tier 1 and tier 2, it applies to all the employees, whether they're on probation or not, deduct, and then either take it to the private fund scheme for everyone or take it to NSSF. But of course, we're already figuring out going to Old Mutual is way better. All right. Yes. Is there a minimum number of employees an organization should have to be able to contract out, or you're happy to take 5?
NSSF says statutory deductions start with 2. So we go with that.
Yeah. All right. That's a very good response. The other thing is, if there's already a provident fund in place, can the contribution be channeled to the provident fund vehicle? I think you've mentioned about the regulations that are being set up for the one that was currently existing. So I hope the person who asked that question was answered. What happens when I move jobs and my former employer had contracted out, but my new employer is not and is engaged with a different pension fund? What happens?
So if your new employer has not contracted out, it means your current contributions start going to NSSF back again. What you can do with your from your former employer is you can transfer them into an individual fund. It's not mandatory that they go back to NSSF. So you're putting them into an individual fund to be able to have oversight over them, also keep the earning capacity going. And so because it doesn't make sense to move from a high earning fund to a lower earning fund. What we want to say is we expect, though it's not in practice right now, remember you've been saving in NSSF for the last 2 years. That fund is called a credit. So the essence of the law is that when an employer contracts out, the credits that are already at NSSF should move to your new scheme, the contracted out fund, your private fund. That's not happening, but in law, it should happen. So we expect as we continue implementing that this will now be implementable. So then it also means that as you change employers, whatever was at NSSF can also move out and be added on. So that's the beauty of the Act, allowing you portability as you work.
All right, great. Thank you, Christine, for that and highlighting that our money should be moved, but it will not be moved. We are taking note. It will stay on the other side. So someone is asking, will work be facilitated by separating tier 1 and tier 2 deductions? Yes, sure. At the point that you're making a decision that you're contracting out, you'll be able to access reports on your tier 1 and what is on the tier 2. Now, Christine, there's a question here about the payout schedule. I believe everybody is already thinking about when I'm 60, what will I be doing? Did you mention something about a third payout schedule or something on that? What was it? Was it 14 million? I believe the figures are very exciting.
Yeah. So let's assume our 14 million. So it's, in essence, when you reach the age of retirement, the law provides that the tier 1 and the tier 2 will be combined, and they'll be combined in your private fund. So when they're combined in your private fund, 1/3 will be payable in cash. So taking someone who has a fund of 10 million, if you want, it's not mandatory, but the maximum you can take is 1/3. Right. So 1/3 is 3 million. You can take it out in cash. There'll be no tax payable on that amount as per the current law. The 2/3 which remain, which is 7 million, you then convert into an income for retirement. And the options are what we call an annuity, which is purchasable from any insurance company of your choice, or an income drawdown, which is purchasable from any fund manager of your choice in the market. I'll leave it at that.
All right, thank you. So someone is asking here, can an employer who does not have an umbrella scheme establish a standalone provident fund specifically for contracting out and receiving the NSSF Tier 2 contributions to make use of the higher interest?
So the question would be, if there's a vehicle in the market available for you to plug and play, why would you want to go through the pain of setting up your own retirement fund? I'm not going into details, but it's a long journey involving KRA and the Retirement Benefits Authority and lawyers and documents and training and building capacity within your staff. Yeah, you can, but it's not the it's the rocky path. Yeah.
All right. If an employer wants to contract out, remember the process that you said, how do I go about it, the board resolution, etc. If an employer wants to contract out, but does it mean all the employees must be on board? What happens if some employees are not willing to move from an NSSF? I wouldn't get it why they would want not to move from an NSSF, but Christine, please enlighten us.
Statutory deductions are the responsibility of the employer. Choose a stand and take it.
Okay, so you get to determine where the employee's money is gonna go to. But you said, so what you're saying is that from an employer's perspective is just informing them.
Yes,
it's not consulting them.
But remember, nothing is done. I mean, when there has to be engagement with the staff. But if you have dissenters, they can't hold the whole group in terms of, you have to understand their key concerns. But the law places the responsibility with the employer. It's not a democratic issue, but there is, you can seek engagement and consensus. It's very important, in my view, if you ask me.
Okay, sawa. There's someone also here asking, and this is from Pretty Shah. Sorry, I have not been mentioning people, but I can see some of our WorkPay clients here. Really happy to hear the great questions you guys are having. If a company is registered with a private scheme, is it a must for all staff to contribute to private scheme? I don't want to answer that, but over to Christine.
Okay. In the private scheme, I think it's a contractual engagement. It depends on whether it's a benefit your employer has given you. That's it.
Yeah, perfect. So yeah, pension, private pension provided by an organization is a benefit. So it depends on the contract you're on. Doesn't mean that everyone has to be on it. I almost want to say depends on how you negotiated for whatever benefits you're going to get on board on. Yeah, someone is requesting for the slide. We'll share the slides after this. Someone is also asking a very quick question, but I remember you answering. Is the interest compounded or simple interest rates for NSSF? This is a question from Nelias.
Compounded. Retirement funds compound. So there's no differentiation between how the private scheme and the NSSF scheme will earn, which is why you're taking it private.
Okay. All right. I am a consultant in one firm and all my employer deducts is 5% withholding. Am I still required to remit Tier 1 and Tier 2 to NSSF, or can I just adjust and set up a Tier 3 with a private fund? I don't want to answer that, but Christine?
I think you're your own employee.
Yeah.
Maybe you can, you're your own employee, like Joelina. I think Joelina can back me up. So I think you set up your Tier 3.
I agree, because we have different types of employment types. Firstly, to respond to you, so we have the probably permanent and pensionable, we have employees on contract, and then we have people like interns, casuals, etc. And the statutory deductions required from them are different. For example, for you as a consultant, the only deduction your employer can deduct is 5%. From a statutory perspective, that is your statutory obligation. So in regards to the NSSF, you're not obligated, but because you want to retire and be comfortable 30, 20, 40 years from now, would be highly recommended to just go and join Old Mutual's private fund for your pension. All right. More than happy to share all this information over to the people who are requesting for these particular slides that you have. We'll combine them into one document, and we're more than happy. Someone is saying Tier 3 is new to many. Would you want to expound a little bit more on it? Probably, Christine, you can take a minute before we run our final poll. I can see all our questions are out.
Okay.
Yeah.
So Tier 3 was named because NSSF came in with Tier 1 and Tier 2. So when you're employed at a place of work, your employer could choose to set up a retirement fund for you, like he could choose to give you a medical cover, or he could choose you to give a meal allowance or meal benefit. So that means that in your contract, there's a deduction that is set saying, I, the employer, will contribute X value to your retirement fund, and you in turn will be deducted X to go towards a refund. So this then would what we call private retirement benefit schemes that are registered under the Retirement Benefits Authority. And it's where we were saying you can either do it as an occupational standalone, you can do it under the umbrella situation, or you can do it under the personal pension situation. Depends on the solution you choose. So I think I'd pause there. That's what we are calling Tier 3.
Thank you, Christine, for that. One final question in the chat. The Kenya shillings 3840 Tier 2 2025, is it standard amount for everyone regardless of one salary? Of course, taking into account the upper and lower limit. I'd want to respond to that based on the things that I have got, teacher, me. So the Tier 2 bit is dependent on the difference. If you're below 72,000, but if you're above 72,000, then that is the max. Christine, mark my results. Great. So the maximum amount is 72K. So 6% of 72,000 is the total. But if you're considering Tier 2, the maximum you can pay is 6% of 64,000, which is 3840. All right, great. Let's go to the polls. I don't think we have any more questions. Kindly share this. Yeah, we will share all these. What is your source of information that NSSF pays 4% as opposed to the private pension? This is from Collins. We're back again to a few questions. We're taking one last one. We want to wrap up in the next, say, 5 minutes max. Christine? There's a question for you about the source of info for the 4% as opposed to the private pension fund.
We used an average of what has been shown in the past using member statements. There hasn't been any published performance. The last one they had indicated around 5%. Yeah.
All right, there's a question, one final one from Sylvia. What do we do about interns who are paid a stipend, like 10,000 every month? Should they be put under payroll statutories like pay, NSSF, SHIF?
I don't know whether it's you or Joshua to answer that. I'm not very clear on that.
Okay, I can take that.
Please, Joshua.
So to answer that, you have to go back to what we call the Income Tax Act, where it clearly specifies what is an employee. And under that act, you will find that an intern is also classified as an employee. So that means by law, you have to deduct the mandatory statutory deductions.
Yes. Thank you, Josh, for that. To expound a little bit more, SHIF and NSSF are benefits to the employee. But when you look at payee, and it is usually banded, it means that if this employee, you're paying them only 10,000 shillings, and on the first category, whereby it's usually 10% of the first 24,000, which is 2,400, and 10% of 10,000 is 1,000. Ideally, sometimes you find the government owing you money, but remember, it cannot pay you back that money. So the employee will still end up not paying any payee to the to KRA and all. But for NSSF, if you deduct that from them, remember it's just going to be 6% of the 10,000. And then now we go back to the shift, which is a benefit from a health perspective. I think the last two are more of benefits. How we are accessing them right now, it's a little bit of a challenge, but then what we're saying, they're bound to be benefits, and they're usually deducted. Remember the tax law for 2024, I think December 27th, that SHIF and NSSF are now deducted before tax. It means that it literally does not affect their net in regards to taxation or this bit around SHIF. All right, we have one final question. I had seen it up there, Caro. I am so sorry. Where a company has two branches, one branch wants Tier 2 and the other wants to stick to NSSF. How do you maneuver? I'm going to send it up to management. Christine?
Employer, you can't separate because the certificate is given to the employer, not to the branch.
Yeah.
So if the employer contracts out, he contracts out for the whole institution.
Not unless there are some branches that usually sit out as separate entities, maybe from a registration perspective. Christine, I'm thinking probably they'd still be able to separate if they're sitting as subsidiaries with separate statutory numbers around NSSF, etc. Is that possible?
I guess if you're registered as subsidiaries, each subsidiary could contract out if they have their own registration within Kenya, separate from the group holding.
Okay.
Yes.
Great. Thank you. I think we have two final questions in regards to the polls. Let's go to the polls, guys, for us to respond. I can see a lot of people have dropped out to just make sure they are on their way home and they're beating Nairobi traffic. How does your company currently handle compliance with statutory deductions like NSSF Tier 2? We can vote in there. Would you be interested in learning more about WorkPay to simplify your payroll and processing and ensure compliance? There's that question as well. There's also the bit of, what is your biggest concern about the NSSF Tier 2 deductions? You can put in some feedback there. Would you consider a private pension fund instead of NSSF Tier 2? Please also put in your answers on those polls. Let's see how the results are looking. I can also see we had a couple of raised hands. I don't know whether we were able to respond to your questions. Just do we have an opportunity to have people speak? Or if you, our time is bad, please. Collins, could you give me a thumbs up if you were able to respond to anything that you had put your hand up for? Marlene as well, Nelly. If we had responded to you, your hands up. If we haven't responded to you, you can give me a thumbs down. Thumbs down, something like this. Marlene, Nelly, your hands are up. I'm not seeing anything on my screen. I'm just going to make an assumption that you have been sorted. Great. All right, great. Let's look into how we are doing. I'm excited about this. People have automated their systems in terms of, how statutory deductions look like. We have 5% who handle it manually. We rely on an external accountant. We're still figuring out the best approach. you know where to go or where to come. Let me not say go, where to come. Let's look at the question about what is your biggest concern. Of course, there's the bit of the reduced take-home pay, compliance and legal requirements, whether private pension funds are better, lack of clarity on long-term benefits, and that is where Christine shed a lot of light in regards to that. Going back to, would you consider private pension funds? Nobody wants to stick with NSSF. Christine, to give you some insights. 3% are like, no, I don't want. Yes, it sounds like a better option. Definitely a better option if you think about it long term. Not sure yet. We have a 41%. I'm wondering why we have not been convinced yet by Christine, but I know it's usually a lot of fact finding, a lot of tests, a lot of pivoting, and I'm sure you will still find that Old Mutual and other private pension schemes are the good places to go to in regards to your money. Do we call it old money? Will it be old money then? Jess, would you like to explore learning more about WorkPay? I see 69% are here and they're saying, yes, we'd want to explore WorkPay. Of course, if it saves time, okay. We see a couple of people who've already figured out. That's really great. And then we are also seeing a couple of people who are saying not sure. I think probably we'll share with you more additional information of why this would be of value. That being said, I want to extend heartful gratitude to everyone who participated in this particular session. Starting off with the person who organized this, just thank you very much. Ex-WorkPay, Joshua as well, thank you so much for the insights and even the numbers. You know, you're the man of the numbers here at WorkPay. Thank you so much for your time. Christine, we are really grateful. I think even for me, I had come in with I don't say an empty brain, there's so much in there, but I just had come in to learn and understand what is this NSSF thing. And I know the next time I'm speaking to someone, I'll be like, you need to opt out of that NSSF Tier 2 and take it to Old Mutual so that you're able to see the benefits both for your employees and even you as an employer. You don't have to complain. You know your money is safe. You're not thinking about where our people are investing their money. Thank you very much to everyone who participated. The participants are great. Your engagement was amazing. And I really want to say thank you, thank you, thank you. Open to our two attendees. Josh, say something. What would be your final words to the team here or the attendees here? I can see a couple of people have dropped off. I believe it's time for people to go home. Josh, say something. Let's go to Christine. 30 seconds each. Then we'll be able to wrap up on what you expect as the next steps and closing. Will you close with a word of prayer? I don't know. All right, Josh.
It was a pleasure to engage with you guys. Thanks for the awesome questions you've asked. Well, I've also learned a lot from Christine, a lot actually. And I hope you have enjoyed the talk, insights, and pressure your company to come to WorkPay for the employees. And we shall assist you in all payroll matters. That's it for me. Juliana, back to you.
Thank you, Josh. Christine, 30 seconds.
Thank you. First, I think it's just to appreciate WorkPay and to appreciate the people who signed in on the meeting and the questions. I want to recognize my colleagues who are in the meeting, Christine, like myself, Moses and Dennis, who are here to support. You never know with technology. Just to say, please engage with your money and keep a close eye on your money. Don't just let it slide every month out of your payslip. It doesn't matter whether it's pension or savings or investment. Wherever you are, I'm a big proponent for financial wellness and looking forward to having you come join us with Old Mutual. We're a great family here. Thank you.
Thank you, Christine. I think what you're saying is that we can only keep track of our NSSF Tier 2 now because the rest, we can't keep track of it. Thank you so much for that. I think this has been very insightful for me, even at a personal level. I have learned a lot. And what Christine is saying is that you can grow your money. employers, whatever you're investing in your employees, you can actually grow it on behalf of your employees. And she has already shown you the way. We have seen the difference, the 6 million versus the 14 million. That's where the money is at. And the, when you always say cash is king, when you're under that, or you're in your mansion, I don't say under a mango tree, but yeah, when you're in your mansion, you already know you're getting some money at the end of the month. Thank you very much, Christine, for that particular information. Now, thinking about the next steps, we will share all this information. We'll put all the slides together and share them out to you, the different people who have sought our help. One person from who is our WorkPay client, please share your email. I see you have shared your email. We'll get in contact with you and support you setting up your NSSF on your WorkPay. Should be somewhere. It's just a button and you're good to go. And then we are also available both from WorkPay and Old Mutual side to try to assist you in your pension transitions, both from an automation of your payroll by WorkPay and now being able to transition your NSSF Tier 2 into the pension scheme. If you're interested in learning more, sign up for a consultation between WorkPay and Old Mutual. We'll also share the contacts for the different contact people, both from WorkPay and Old Mutual, that you can directly contact. That being said, thank you very much. Thank you for sparing 30 more minutes of your time to listen to us. We truly appreciate, and we hope that you can cross over to this side to make your work easier and to grow your money. We can close on the meeting. Feel free to drop off.